Small cap stocks have historically delivered market-beating performance over the long term. However, more recently, the outperformance of small caps has been put into question, as returns have been less impressive and large caps have comparatively delivered much better returns. As you can see on this chart by Schroders here, over the past 5 years and past 10 years, US large caps have outperformed US small caps. Despite this, if invested into at the right time, some small cap exposure may turn out to be a good investment. And now with the Fed funds rate being cut by 50 basis points and potentially more rate cuts to come, perhaps now is the time to consider small caps. They certainly offer an interesting investment opportunity. So in this video, I'll take a look at the investment case for small caps as well as the risks, before taking a closer look at some UCITS ETFs available to UK and European investors for investing in small cap stocks. This video is sponsored by Trading212, the UK investment platform offering you zero commission investing. More on them later. You could look to invest in global small caps, with one such example being the iShares MSCI World Small Cap, ticker WLDS, but I'm going to focus on US small caps in this video. This is because the US stock market is on another level to other markets in terms of number and quality of small cap stocks, and there are many more ETF options, whereas for other markets you'd be lucky to find more than 1 or 2 small cap ETFs. It's also undoubtedly much easier to keep up to date with news influencing US small caps and their valuations, such as through the daily charts on websites like Yardeni Research. Before jumping in, always remember that these videos are not financial advice or recommendation to invest in any of the ETFs featured. None of these examples may be suitable for you. When investing, your capital is at risk and past performance does not guarantee future results. Please do your own further research before investing into anything. So firstly, let's dive further into why small caps are being hyped up right now. Well, as I mentioned, in September, the Federal Reserve cut interest rates in the US by 50 basis points. Small caps in general are sensitive to interest rate news, and they could be set to benefit from lower rates. This is because small caps collectively rely more heavily on external financing than their larger cap peers, so falling borrowing costs can be a tailwind for them. Historically, after a Fed rate cut, stocks across all market caps tended to rally, but small caps outperformed. Take a look at this chart. In the first 3 months, 6 months, and 12 months after a rate cut, small cap stocks have delivered better returns than mid caps and large caps historically. Of course, past performance does not guarantee future results, but it is interesting to see this visualized. The counter argument right now to any small cap outperformance is that the rate cut is already priced in, so upside may be limited. Additionally, some claim that we're in a different world now, where large caps are just better stock market performers than small caps regardless of what is happening, due to globalization and ability to capitalize on opportunities. I'm not going to pretend to be able to predict the future either way here. That's not the point of this video. The second reason that US small caps may present an attractive opportunity at the moment is that they remain incredibly cheap from a valuation perspective. Look at this chart from Yardeni Research. We can see that small caps, as measured by the S&P 600 index, are currently trading at a forward price to earnings ratio of 15.5. This is significantly below their average over the last 20 years or so. On the other hand, the large cap index, S&P 500, is trading at a forward PE of 21.6. And aside from the COVID stock surge, large caps have not been this expensive since the dot-com bubble. So perhaps small caps with their cheap valuation offer significant upside. However, to be clear, things are cheap for a reason, and they can remain cheap for a very long time. So it would be short-sighted to assume that small caps are a good investment just because they're cheap. Regardless, it is something to consider. And one last thing, before we start looking at some ETFs, there are some additional risks to consider when looking at small caps. The main one is that small caps have been observed to have greater volatility and drawdowns than large caps. As you can see in this table by MSCI, their small cap indexes have had greater volatility and worse maximum drawdowns than their large cap indexes. This may be because small caps tend to have lower profit margins, they lack the economic moats that large caps have, and it can be harder for such companies to cope with debt. Therefore, if there is a recession and demand drops, then small caps usually weather the worst of the impact. So if the US does enter recession, small cap returns may take a greater hit than large caps. Turning to how to actually invest in US small caps now, the most popular indexes are the S&P 600 and the Russell 2000. It can be difficult to decide between the two, so I'll briefly go over what each index is, then look at whether one is better than the other. First up, the Russell 2000 index includes approximately 2,000 of the smallest securities listed in the USA. It's constructed to provide a comprehensive and unbiased small cap barometer and is completely rebalanced annually to ensure larger cap stocks do not distort the performance. So investing in an ETF that tracks this index will give you almost complete exposure to the entire US small cap market. On the other hand, the S&P 600 also seeks to track the small cap segment of the US equity market, but it has additional criteria to make sure the stocks included are liquid and financially viable. The financial viability part is the important part, as this filter means that only companies which have positive earnings over the most recent quarter, as well as over the most recent 4 quarters summed together, are included. So essentially, only profitable companies are included in the index, and this is a variant of a quality filter. You could see this as filtering out a lot of the junk stocks which may exist in the small cap segment of the market. Due to this additional filter, I would tend to favour the S&P 600 over the Russell 2000. The data also supports this idea. We can see this in the article A Tale of Two Small Cap Benchmarks 10 years later. This is data compiled by S&P themselves, so they do clearly have a conflict of interest, but with that in mind, they found that over a 1-year period, the S&P 600 outperformed the Russell 2000 67.9% of the time. And when you go across to 5 years, the S&P 600 pretty much wins in every 5-year period, at 98.4% of the time. They also found that the S&P 600 had lower volatility than the Russell 2000, thus giving superior risk-adjusted returns. Although S&P aren't exactly independent on this matter, they can't really fake the data, so it is interesting to look at, and it does make me personally lean towards the S&P 600. Again, remember, past performance does not guarantee future results, and there could well be some good reasons to pick the Russell 2000 over the S&P 600. Here's some examples of ETFs for the two indexes available on Trading 212. So first of all, for the Russell 2000, there are quite a few options available, but given we have so much choice, I'll stick to the ones that trade in Great British Pounds. As UK investors, we can avoid FX fees by sticking to ETFs that trade in our own currency. The main two options are R2SC by SPDR, which uses sampling to replicate the index, and XRSG by Xtrackers that uses full replication. These both have total expense ratios of 0.3% and fund sizes of 2,603 million and 1,086 million respectively. A past performance chart does reveal a slight outperformance for the SPDR one, but it is by a tiny margin, and of course past performance does not guarantee future results. The last Russell 2000 ETF I'll mention is one that is slightly different. It's the Legal & General Russell 2000 US Small Cap Quality ETF. So as you can tell by the name, this tracks a variant of the Russell 2000 with a quality filter. In that sense, it may be closer to an S&P 600 ETF in practice. This ETF has the ticker RTWP and a total expense ratio of 0.3%. Surprisingly, the fees are not higher than the standard versions. Fund providers usually do add a bit onto the fees when they use a variant of an index, so it's nice to see that is not the case here. Comparing it to the standard Russell 2000 ETFs does reveal a slight outperformance historically, so perhaps the quality filter is working. The only reason I question otherwise is that it does seem that in the period 2015 to 2022, there was no difference in performance at all. I wonder why the quality filter has led to a difference recently though and not before. Now, moving on to the S&P 600, we really do not have much choice here at all. There are a couple options, but only one trades in Great British Pounds. That's the iShares S&P Small Cap 600 with the ticker ISP6. It has a total expense ratio of 0.3%, and annoyingly, it only comes in a distributing version. The other option is USML, and this does have a much cheaper total expense ratio of 0.14%, but it does trade in USD, so you will have to pay foreign exchange fees when buying and selling this ETF if you hold GBP. For that reason, I personally prefer ISP6, but I can see a case of going for USML as well. Adding ISP6 onto our chart with the Russell 2000 ETFs does reveal that it has delivered the best returns, so perhaps that profitability filter that S&P have used really does work. Although, again, I will stress that it is a small difference and it may not repeat going forward. Before going on to other options, I wanted to thank Trading 212 for sponsoring today's video. Trading 212 is one of my favourite UK investment platforms that I have been using even before I started this channel. It is among the cheapest options available for UK investors, with zero account fees, zero commission on trades, and an FX fee of only 0.15%. It's not just about low fees though. Trading 212 currently boasts a market-leading interest rate of 5.1% AER on your uninvested cash in their Invest and Stocks ISA accounts when you agree to the terms regarding qualifying money market funds. They also offer 5.1% AER in their cash ISA as well, all held in banks. I've been really enjoying getting those daily interest notifications. If you'd like to get started on Trading 212 as a viewer of my channel, by signing up through the link in the description, you can get a free fractional share worth up to £100. Alternatively, within 10 days of opening your account, you can use the promo code TOM to claim your fractional shares. Always remember that when investing your capital is at risk, and for the offer, terms and conditions do apply. Alongside the S&P 600 and Russell 2000 ETFs, there are also many more interesting and more niche small cap ETF options. I'll go through a couple of them now. First up, we have the SPDR MSCI USA Small Cap Value Weighted ETF with the ticker USSC. This has a total expense ratio of 0.3% and, as the name suggests, combines the value factor with the size factor. For those who are interested in a potential small cap value premium, this one is worth looking into. As I show in my portfolio updates, I do currently hold this one in my Trading 212 ISA. Unfortunately, it does only have a version that trades in USD, so there will be an FX fee to pay when buying or selling, so that is always worth keeping in mind. Looking at the fact sheet for the index it tracks, we can see it is based on the parent index MSCI USA Small Cap, but it reweights each security to emphasize stocks with lower valuations. This is determined by using fundamental accounting data, sales, book value, earnings, and cash earnings, rather than market prices. The existence of a value premium is somewhat put into question by the chart here, with there not being any difference of much significance in recent years. However, below we can see that if we look at annualized returns since December 2000, there has been a noticeable premium going further back. Perhaps this shows that the value factor really just has been out of favour recently and may return. Who knows? I would be interested to hear your thoughts on this index and the ETF that tracks it in the comments below. A just ETF comparison does reveal outperformance on a 5-year chart, with perhaps the recent rate cuts helping spur small cap value stocks on. Okay, now the last ETF I'll have a quick look at is one by JP Morgan, which tracks the Morningstar US Small Cap Target Market Exposure Index. It has the ticker BBSC and a very cheap total expense ratio of only 0.14%. This one is less well known and hasn't been out for long, but as it is cheap, I thought it'd be worth looking into. There does not seem to be anything too special about the index they've selected, but this article around the time of launch does state that it offers investors access to around 1,500 small cap companies in the US, and according to Morningstar, the index can also include mid-cap companies in a bid to limit excessive turnover. I am hesitant to look at a performance chart for this one, as it has only been out since August 2022, so there's really not much data to go off. That being said, with a big caveat, we can see it has outperformed S&P 600 and Russell 2000 ETFs, but underperformed the small cap value ETF over that period. This is one I will keep my eye on going forward. Overall, I'd have to say we are spoilt for choice when it comes to US small cap ETFs. You'll note that I did not include a holdings breakdown for any of the ETFs I ran through, and that's simply because I do think that with a small cap ETF, it is much less useful and interesting to look at the top 10 holdings, as it is unlikely we've heard of most of them anyway. With them being small caps, the individual companies rarely feature in the news and are just not very well known. And investing in individual small cap companies is very risky, so buying an ETF that contains hundreds of stocks for general small cap exposure and not really caring about the underlying holdings is probably a good way of going about investing in small caps, in my opinion. You may disagree, of course. It will be interesting to see how small caps perform going forward, and whether rate cuts, those already had and potentially further ones coming, lead to any outperformance. As with all things in investing, there's no guarantees and no way of predicting the future. If I could do that, my portfolio would be a lot bigger than it currently is. That is it for this video. Let me know what you think of small caps in the comments below, and if you enjoyed the video, please do leave a like and subscribe for more investing content. Don't forget the offer from Trading 212. You can get a fractional share worth up to £100 by signing up through the link in the description. Let me know what you get, and as always, thank you for watching.